Ethereum's native token Ether has exploded to a fresh all-time high in late August 2025, briefly topping about $4,880. This parabolic move capped roughly a 40% year-to-date rally, far outpacing Bitcoin and reigniting investor excitement. The break above the prior record, $4,878, in November 2021, occurred on August 22, 2025. As Ethereum surged roughly 15% in a single day, such a sharp uptick was driven by powerful macro tailwinds. In particular, Federal Reserve Chair Jerome Powell's speech at Jackson Hole took on a notably dovish tone. Powell suggested the Fed could cut interest rates as soon as September, saying the stable job market allows us to proceed carefully on policy, though inflation risks remain. Markets immediately reacted. U.S. stocks surged, the S&P 500 and NASDAQ hit record highs. Traders pushed the odds of a September rate cut to about 90%. This liquidity-friendly shift sent capital into risk assets across the board. Reported Ether rose nearly 15% in 24 hours to a record $4,866 on Powell's hints of easing. In short, Ethereum's breakout was no accident, but part of a broader risk-on jump in late August. As investors anticipated looser monetary policy, institutional demand has reinforced the rally. Ethereum-focused exchange-traded funds, ETFs, and investment products have seen record inflows, dwarfing those into Bitcoin, according to CoinShares. U.S. Ethereum ETPs drew about $2.87 billion in net inflows in 1 week in mid-August, roughly 77% of total digital asset inflows. That record put year-to-date ETH fund inflows at $11 billion, lifting assets under management to all-time highs over $32 billion. CoinShares also noted that during the week ending August 15, 2025, Ethereum investment products attracted $2.86 billion, versus only $552 million for Bitcoin products. In other words, Bitcoin's market share is slipping. Its dominance fell below 60% for the first time in months, as altcoins led by Ethereum surged. Money has clearly been rotating into Ether. Likewise, on August 21st, US ETH ETFs alone netted a $287.6 million inflow, lifting total ETF AUM to about $12.1 billion. These flows suggest that both retail and institutional buyers are piling into Ethereum right now. Corporate treasuries are piling in as well. Multiple firms have adopted Ethereum as a treasury asset, buying large amounts of ETH as a hedge or yield strategy. For instance, BitMine Immersion Technologies now holds approximately 833,100 ETH worth $3.6B, after a huge increase in its position, and SharpLink Gaming holds approximately 521,900 ETH. In aggregate, CoinMarketCap reports that corporate ETH treasuries reached over 3.04 million tokens, about $13 billion. As prices passed $4,300, Cointelegraph's analysis notes about $1.6 billion of ETH purchased by corporate entities in just the past month, bringing total corporate holdings to roughly $29.8 billion. The implication is that some companies view ETH not just as a short-term bet, but as a long-term reserve asset. As Ray Youssef, CEO of crypto app No One's observed, Ethereum is increasingly seen as a utility-rich reserve asset rather than a mere speculative token indeed. Ethereum's ecosystem, with staking yields and fee burning, gives it appeal as an ultrasound money alternative in some treasuries. This wave of corporate adoption reinforces the bullish narrative. Sizable new buyers have appeared to absorb any selling at these highs. Ethereum's underlying technology and use cases also support the optimism. The network has become the dominant platform for smart contracts, DeFi, and stablecoins. Most dollar-backed stablecoins like USDC, USDT run on Ethereum, so growth in that sector directly increases demand for ETH as the network's fee currency. In fact, Standard Chartered analysts point out that if the stablecoin market grows by 8x by 2028, Ethereum's fee revenue could soar, boosting the token's value. The merge to proof of stake and EIP 1559 fee burning have also made ETH issuance very low in many months. More ETH is burned in fees than is issued, making supply somewhat deflationary. Staking withdrawals and token unlock schedules will gradually release supply. But for now, Ethereum's monetary policy is among the most conservative of major crypto. On the user side, the recent Incon upgrade 2024 lowered Layer 2 costs and should improve scalability over time. This technical progress means Ethereum can handle growing demand for DeFi, NFTs, and institutional applications while preserving decentralization, a key bullish factor. Analyst forecasts have turned aggressively bullish on this strength. In mid-August 2025, Standard Chartered updated its ETH price targets dramatically, $7,500 by year-end, up from $4,000 and $25,000 by 2028. Likewise, some traders and on-chain analysts predict even more, with targets of $10,000, $13,000 within months. These forecasts rest on assumptions like continued Fed rate cuts, rapid DeFi expansion, more ETF inflows, and wider crypto adoption. As one crypto analytics firm put it, a perfect storm of factors: strong ETF and Treasury demand, supportive legislation for stablecoins, and booming DeFi activity is creating unprecedented demand for ETH. In practice, investors are already acting like this. Ethereum's market cap just helped push the total crypto market value above $4 trillion. With ETH around a $2 trillion cap, this scale dwarfs the entire crypto space just a few years ago. Reflecting how far the market's confidence has come, these developments could signal a sustained all-season, where Ethereum and large-cap altcoins outperform Bitcoin. The drop in Bitcoin's dominance to below 60% is one symptom, and big traders sense that Bitcoin's rally has stalled or that markets want more leverage exposure. Money often flows into altcoins. For example, reports show that while $2.96 billion poured into ETH funds in recent weeks, Bitcoin funds actually saw about $21 million of outflows. Indicators like the altcoin season index are trending bullish. In short, the current trend suggests capital is chasing returns beyond Bitcoin, with Ethereum as the prime beneficiary due to its size and liquidity, risks, and caveats. Not everyone is convinced this run is sustainable. Volatility is extreme at these levels. The very breakout itself spurred massive liquidations. One CoinDesk report calculated about $375 million of crypto futures were wiped out during the spike, with roughly $150 million of ETH short positions getting liquidated as ETH jumped approximately equals 10%. That means many leveraged traders were caught off guard, and it highlights how momentum-driven this rally is. Whenever a rally is fueled by so much leverage and speculation, there's a risk of a sharp reversal if sentiment sours. CoinGlass data, as reported, also showed rising open interest even after the spike, meaning more money is flowing in, but that also sets the stage for bigger losses on the downside if prices falter, technically. Ethereum is entering a decision zone. The $4,800 area is now a critical resistance level, a psychological barrier. It has tested many times since its 2021 peak. Chart patterns hint at mixed signals. Some indicators show overbought conditions or bearish divergence around current prices. Large holders' whales have indeed been accumulating in recent months, which is a positive longer-term sign, but they could also liquidate for profit after this historic run. In fact, analysts caution that historically, past tops often formed when early Ethereum adopters from 2015 to 2017 cashed out. One on-chain analysis firm noted that at prior ATH levels, a selling lead to corrections, and while current demand is strong enough to absorb much of the selling, any shift in sentiment could invite renewed supply into the market. Short, if this supply-demand balance were to tip, for example, if new bullish narratives weaken, prices could reverse sharply. Macro risks remain as well. The current optimism depends heavily on continued Fed easing. If inflation surprises on the upside or the Fed stays more hawkish than expected, liquidity could tighten. Markets are pricing in nearly a 100% chance of a cut by mid-September, but that is still a bet. Should actual Fed actions disappoint, all risk assets, including ETH, could drop. Moreover, global economic uncertainties, potential fiscal stimulus, geopolitical turmoil, or shifts in currency markets could alter capital flows. For example, even a rising US dollar DXY moving above 98 could dampen crypto interest. Regulatory and structural headwinds also lurk. On one hand, recent legislation, the US Genius Act for stablecoins, and SEC decisions like approving in-kind ETH ETF redemptions have encouraged institutional flows. On the other hand, compliance requirements continue to cast shadows. In the US, the SEC hasn't definitively declared ETH a security, but its stance on staking and DeFi tokens is unclear. The EU's MICA regulation, while creating some clarity, imposes strict rules on issuers and wallet providers. Cross-border regulatory clashes remain a wild card. Any harsh crackdowns on exchanges or DeFi platforms could slow Ethereum's momentum. Some analysts point out that until regulators form a consistent global framework, policy uncertainty can cause big swings in crypto markets. Finally, competition and scaling issues are a factor. Ethereum is far from alone in the smart contract race. Chains like Solana, Avalanche, or Layer 2 rollups could draw developer interest and capital, especially if Ethereum network fees spike or if major upgrades are delayed. The recent Dencon EIP 4844 upgrade has reduced Layer 2 costs, but some inefficiencies remain, for example, blob space complexities. If network congestion returns as more users pile in, it could erode one of ETH's advantages. Alternative protocols might natively attract tokenized versions of major assets USDC on Algorand, etc. Any such shift would undercut the thesis that Wall Street's blockchain must be Ethereum. Conclusion. In summary, Ethereum's run to $4,880 is backed by strong catalysts, dovish Fed policy expectations, surging ETF and corporate demand, robust network fundamentals, and bullish forecasts. It represents both a macro-led rally and a possible structural shift, with capital rotating into ETH and DeFi. However, investors should weigh the parabolic nature of the move. High leverage and frothy sentiment mean pullbacks could be sharp. Moreover, anything that undermines the current perfect storm like a Fed hawkish surprise, red, headwind, or technical bottleneck could stall or reverse gains. Balanced analysis suggests that, while Ethereum has significant upside drivers, the risks are non-trivial. The market is at a crossroads. Sustained follow-through could propel ETH into unprecedented levels, but a misstep could trigger profit-taking. In volatility, savvy traders will monitor liquidity conditions, regulatory developments, and on-chain flows closely to judge whether this rally represents a new paradigm or a cycle peak.